Hello and welcome to Earnings Echo. We put together the most important information about Monday.com.
Okay, let's jump right into the hard data for Q4 2025. On the surface, Monday.com had an absolutely stellar quarter.
Stellar how? Give me the numbers.
Revenue hit $333.9 million. That's up 25% year over year. And it beat the analyst consensus of $329.5 million.
Okay, so top line beat. What about the bottom line?
Same story. EPS came in at $1.04, which was well ahead of the 92 cents the street was looking for.
So a double beat,
Yeah.
top and bottom.
Uh-huh.
And yet, looking at the after hours, the stock is getting punished. That's the disconnect I want to understand.
It is, because the market is always forward-looking. It's not about what you did, it's about what you said you're going to do.
And the guidance was weak.
The guidance was a major letdown. Management is forecasting revenue between $1.45 and $1.46 billion for 2026.
And the street wanted more.
They wanted $1.48 billion. So not only a miss, but the implied growth is just 18 to 19%.
Wow. Okay, so you're going from 27% growth in 2025 down to the high teens. That's a serious deceleration. The market is basically punishing this correction of the long-term growth story.
That's exactly it. So if that old engine is slowing, the question is, what's the new one?
Exactly. Where is the business actually performing? What's driving things?
The whole engine is shifting gears. It's all about their upmarket move. They're going after enterprise clients, whales, not minnows.
And is that working?
The numbers are pretty clear. Customers paying over $50,000 a year now make up 41% of Monday's total annual recurring revenue.
41%. That's a huge piece of the pie.
It is. And the cohort spending over $500,000 a year, that grew 74%.
So they're proving they can land real enterprise contracts. It's not just a tool for startups anymore. Is this a sales effort, or is the product pulling its weight?
Oh, the product is doing some very heavy lifting. Specifically, their new AI app builder, Monday Vibe.
I saw that mentioned. What are the numbers there?
It hit $1 million in ARR in just 2.5 months. That's the fastest product launch in the company's entire history.
That is impressive speed. But I'm looking at the profitability, and I see a potential issue. Operating margins actually dropped to 13%, down from 15% a year ago.
They did.
If they're landing these huge, efficient enterprise deals, shouldn't margins be expanding, not contracting?
You'd think so, and that's the right question to ask. But this wasn't really an efficiency problem. It was a currency problem.
FX headwinds.
Exactly. The Israeli shekel got a lot stronger. Since a lot of their costs are in shekels, but their revenue is mostly in dollars, that creates a drag.
How much of a drag are we talking about?
It was about 180 basis points. So almost 2 full percentage points of margin just vanished into the currency exchange.
Okay, so without that, the core business is still getting more efficient. Let's switch to the sentiment on the earnings call. The tone. You said they're hunting whales, so what about the small fish? The SMBs?
They're basically moving on. Management described the SMB market as choppy.
Choppy, meaning what? More expensive.
Yes. The cost to acquire those smaller, no-touch customers is going up and the returns are going down. They're shifting that investment over to the sales-led enterprise side.
That seems logical. But something else on that call really seemed to unnerve investors. They went silent on their long-term targets.
They did. Management completely stopped discussing their previously issued 2027 financial goals. They said they're now focused exclusively on executing for 2026.
Wait, they just abandoned their own long-term map? For an investor, that's a huge red flag. It creates a vacuum of uncertainty.
It absolutely reduces visibility. When you pull a long-term anchor like that, the silence speaks volumes.
But are they at least keeping the customers they have? What does retention look like?
That's the silver lining. The bucket isn't leaking. Net dollar retention is holding stable at 110%. So existing customers are staying and spending a bit more.
So we've put it all together. What's the story here? It feels like the company is at a crossroads.
I'd call it a maturation more than a crisis. They are transitioning from that viral, high-growth SMB tool into what they hope will be a durable, multi-product enterprise compounder.
Okay, so what's the main takeaway? The echo for today.
The investment thesis has changed. It now relies on AI adoption through things like Vibe and on successfully cross-selling their other products, CRM, dev, service to those big clients they're landing. The days of easy self-serve growth are over. The focus now has to be on efficiency over raw speed.
A necessary, if painful, pivot. And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.